let's summarize where we've been. We're starting with the stock market. When's it a good bet? When isn't it? Well, one thing you definitely want to avoid is the kind of debacle we had when the dot-com bubble burst and the stock market collapsed. And so what we've done is we've taken a look at a broad sweep of history here. And we've said to ourselves, well, what can the stock market's history tell us? Can it show us how to avoid trouble in the future? And so what we did was review the record. And what we found was that we have a measure of speculation called the price-earnings ratio. And when the price-earnings ratio rose to unusual levels in the 1990s, that told us that the stock market was marching forward much more rapidly than the earnings of the underlying firms. And that tells us that investors were overconfident in the kinds of gains from productivity improvements and efficiency improvements that the personal computer revolution would bring. And so when the stock market collapsed finally, because those earnings gains just weren't as rosy as speculators had hoped, when the stock market finally collapsed, it brought about, in the years since the collapse, since the year 2002, a much healthier growth in the stock market. Earnings have grown beyond the level that they had once reached, and still stock market investors haven't pushed the stock market well beyond the peak it had reached in the year 2000. So investors have been more cautious and much less willing to bid the value of stocks up beyond a level justified by current earnings.